The bulls are calling it a base. The bears are calling it a dead cat bounce. And honestly, the data tells a more complicated story. Here's what just happened. Silver futures rebounded sharply into the mid-70s after a brutal sell-off. The U.S. 10-year yield remains elevated at 4.09%, and that's a macro headwind we need to unpack. And critically, COT data shows speculative longs are being trimmed. That last point, that's the one that should have your attention. Because when leveraged funds start reducing long exposure during a recovery, that's not confirmation, that's hesitation. That last point, that's the one that should have your attention. Because when leveraged funds start reducing long exposure during a recovery, that's not confirmation, that's hesitation. Now, before we go any further, if you find this kind of breakdown valuable, consider subscribing. We do education first, risk-aware market analysis here. No hype, no pump, just frameworks you can actually use. And drop a comment below. I'll ask you 2 specific questions at the end that I genuinely want your take on. But here's the first cliffhanger. There's one specific ratio in the COT data that historically precedes either major breakouts or major breakdowns in silver. And when I show you where that ratio sits right now, you'll understand why I'm watching this week very, very carefully. We'll get there. But first, let's understand why this rebound matters in the bigger picture. Okay, let's set the table. Silver has been trading in a roughly $74 to $80 range. And right now, we're attempting to stabilize in the mid-70s. Call it the $76 to $78 zone. The mid-70s region, roughly where we saw last week's lows and some prior weekly closes cluster, that's acting as near-term support. Resistance, the $80 psychological level. Round numbers matter. They're where options cluster, they're where retail places limit orders, and they're where moves tend to stall or accelerate. We've already seen a rejection near that zone. The question now is, was that rejection temporary or structural? And here's where most people get this wrong. They look at price and ask, is it going up or down? That's the wrong question. The right question is, who is positioned for what, and what would change their behavior? Price tells you what happened. Positioning tells you who believes what. This is why we need to talk about market plumbing. Because the commitment of traders report, it's a positioning X-ray, and right now that X-ray is showing something interesting. All right, let's demystify the commitments of traders report, the COT, because once you understand this, you'll see markets differently. Every week, the CFTC publishes data showing who's positioned how in the futures market, and the 2 categories that matter most are non-commercials and commercials. Non-commercials, these are your speculators. Hedge funds, CTAs, momentum traders. They're in the market to profit from price direction. Commercials, these are your hedgers, miners, refiners, industrial users. They're in the market to manage business risk, not to bet on direction. Now here's the current snapshot as of February 10th. Non-commercial positioning, 36,660 contracts long versus 13,705 contracts short. That's a net long of roughly 23,000 contracts. Sounds bullish, right? Specs are long. But here's the catch, and this is important. It's not about the level, it's about the change. What we're seeing is speculative longs being trimmed, not collapsed, not liquidated in a panic, just quietly reduced. That tells me the momentum crowd is not confident. They're not adding to longs on this rebound. They're lightening up. Now look at the commercial side. 79,558 contracts short. That's hedgers, likely producers, locking in prices. They're structurally short because that's what hedging looks like. But the size of that short position matters. When commercials are heavily short and specs are reducing longs, that's not a setup for an explosive rally. That's a market in negotiation. And then there's open interest, total contracts outstanding. At 133,641, it's stable, not expanding, not collapsing. Here's the plain English. Participation is steady, but conviction is fading. Now, remember that ratio I mentioned, the one that precedes either breakouts or breakdowns? Here it is, the non-commercial long to short ratio. Right now, specs hold about 2.67 longs for every short. That's elevated, but it's declining. Historically, when this ratio peaks and starts falling while price tries to rally, it often precedes a failed breakout. The specs lose faith before price confirms. But, and this is the key, if this ratio stabilizes and open interest expands on a price move higher, that's accumulation. That's a potential base. So which one is it? We don't know yet. And that's exactly why we need to cross-reference other markets. Silver doesn't exist in a vacuum. It trades in a web of relationships. And right now, The three most important threads are yields, the dollar, and risk appetite. Let's start with the big one. The US 10-year Treasury yield is sitting at 4.09%. That's elevated by recent historical standards. And here's why it matters for silver. Silver pays no yield. Zero. A Treasury pays 4%. When you hold silver, you're giving up 4% annual return you could get from a risk-free government bond. That's the opportunity cost. The higher yields go, the higher that opportunity cost, and the less attractive silver becomes, especially to institutional allocators who think in risk-adjusted terms. Now, 4.09% isn't a death sentence for silver. We've seen silver rally with yields above 4% before, but it is a headwind. It's friction. And when specs are already reducing longs, friction matters more. Now, the dollar index, DXY, unfortunately I don't have a confirmed print for you today. The official page didn't update cleanly as of recording, but here's what I can tell you. The dollar remains a critical variable. Silver is priced in dollars globally, which means dollar up leads to silver relatively more expensive for foreign buyers, which creates demand pressure. Dollar down means silver is cheaper internationally, which creates a demand tailwind. If you're watching this, keep DXY on your radar. If it breaks higher, especially above recent resistance, that's a headwind confirmation. If it rolls over, that gives silver room to breathe. And then there's equities and risk appetite. Here's the thing, silver is a weird asset. It's part precious metal, part industrial metal, so it doesn't always correlate cleanly with gold. When equities sell off hard, you sometimes see silver underperform gold because of recession fears hitting industrial demand. When equities rally on growth optimism, silver can outperform gold because industrial demand expectations rise. So right now, I'm watching whether equities stay stable or show cracks. If we get a risk-off move in stocks combined with higher yields, that's a pincer move on silver, squeezed from both sides. Higher yields plus stronger dollar plus risk-off equities equals triple headwind for silver. That's the worst-case macro cocktail. We're not there yet, but we're closer than I'd like. And this brings us to the two scenarios I've mapped out. Because what happens next depends heavily on which path confirms. And I have a specific checklist for each. Let's walk through them. Scenario A is the constructive path. This is where the current rebound proves to be legitimate accumulation, not a sucker's rally. Here's what would confirm this scenario. First, price holds mid-70s support on any retest. If we get a pullback and buyers step in aggressively at 75 to 76, that's a higher low. That's constructive. Second, COT shows stabilization or increase in non-commercial longs. If specs stop reducing and start adding, that's conviction returning. Third, open interest expands on up moves. This is key. Price rising with expanding open interest means new money entering long. That's real demand, not short covering. Fourth, 10-year yield stabilizes or rolls over. We don't need yields to collapse, we just need them to stop climbing. A pause at 4.09% or a drift toward 3.9% would reduce the opportunity cost headwind. Fifth, dollar weakness emerges. If DXY rolls over and breaks below recent support, that's a tailwind for commodities priced in dollars. If this scenario confirms, we'd likely see silver break above $80 with conviction, potentially opening a measured move toward the mid-80s. But, and I need to be clear here, we do not have confirmation yet. This is the hopeful path, the possible path, the path bulls want. What we have right now is stabilization without confirmation. That's different. Let me show you what denial looks like. Scenario B is the cautionary path. This is where the rebound fails and silver reveals itself to be a bull trap, a head fake that draws in late longs before reversing hard. Here's what would confirm this scenario. First, price breaks below mid-70s support decisively. A daily close below $74, especially on elevated volume, would be a structural breakdown. Second, COT shows continued reduction in non-commercial longs. If specs keep trimming even as price stabilizes, they're telling you they don't believe the rally. Third, open interest falls on price declines. This would signal long liquidation, trapped buyers getting out. Fourth, 10-year yield pushes above 4.25%. Higher yields would increase opportunity cost pressure and likely trigger institutional de-risking from non-yielding assets. Fifth, dollar rallies and DXY breaks higher. A stronger dollar would compress silver demand from international buyers. If this scenario confirms, we'd likely see silver break below $74 and potentially retest the $70 psychological level, or even lower depending on velocity. And I want to be honest with you. Right now, the weight of evidence is not clearly on either side. We're in the messy middle, the zone where patience matters more than prediction. This is why I'm labeling my stance as cautiously bullish. Price is holding. That's real. That matters. But the 10-year yield at 4.09% is a headwind. Specs trimming longs is a headwind. And without DXY confirmation, I'm flying partially blind on the currency impact. Caution doesn't mean bearish. It means respecting uncertainty. All right, here's the part I want you to screenshot or write down. These are the 5 things I'm watching over the next 1 to 2 weeks to determine which scenario is gaining evidence. Number 1, silver's $75 level on any pullback. Does it hold? Do buyers step up, or does it slice through like butter? The quality of the defense tells me everything about demand conviction. Number 2, COT report evolution. I want to see whether non-commercial longs stabilize or continue declining. The report comes out Friday afternoons. I'll be watching February 14th and 21st data closely. Number 3, open interest behavior. Is participation expanding or contracting? And critically, is it expanding on up moves, which is bullish, or down moves, which is bearish? Number 4, the 10-year yield at 4.09%. If it pushes toward 4.25% or higher, macro headwinds increase. If it drifts toward 3.9%, silver gets some breathing room. This is the tug of war that matters. Number 5, DXY confirmation. I need to see the dollar direction clarify. A break higher in DXY equals silver pressure. A rollover equals silver tailwind. This is the missing variable right now. Print this. Bookmark this video. Come back in a week and check these off. Because markets don't give you answers. They give you evidence. Your job is to collect it. And with that, let me give you my final thoughts. Look, I know some of you want me to say buy or sell, but that's not what this channel is about. This is education. This is frameworks. This is helping you see the market through a more informed lens. What you do with your capital is your decision. Silver is volatile. Futures can move against you fast. And if you're trading leveraged instruments without risk management, you're gambling, not investing. My stance is cautiously bullish, but that comes with a clear invalidation. If silver breaks below mid-70s on volume while yields rise and the dollar strengthens, I'm wrong, and I'll say so. The major threat right now is clear. A renewed USD rally or further rise in Treasury yields could quickly invalidate this rebound and pressure silver back below mid-70s support. That's not fear-mongering. That's risk awareness. Know your exits before you need them. Education only. Manage your risk. Always. Okay, I promised I'd ask you 2 questions, and I genuinely want to hear your answers in the comments. Question 1 is a binary choice. Silver at $78, base or bull trap? Type base or trap in the comments. I want to see where this community stands. Question 2 is pick one of 3. Which signal would change your outlook most? Type A, B, or C. A is COT shows specs adding longs. B is 10-year yield drops below 4%. C is dollar breaks down. I'm curious which variable you're weighting most heavily. Let me know. That's it for today. Thanks for watching. If this was valuable, share it with someone who's trying to make sense of this silver market.